Hi there. My name is Austin Lawrence. With Pacific Wholesale Mortgage and MLS number 225079. Just hoping to share with a couple people that are on right now, as well as I'm going to make this into a video. What's going on? And here's the question I keep getting. Are rates ever coming down? Well, what's going on with the rates? And so I wanted to kind of address that. I'm no predictor of these things. I don't have a magic crystal ball, but I can tell you from some statistical studies and some research that I've done, kind of where we're at. So I'm just going to give you kind of a brief overview of what I found and just some obvious just gems in the industry to kind of figure out what's going on and what's about to happen in the industry. What I wanted to start off with is what's happening with mortgage rates, right? And the question is there a recession looming? And what opportunities will that provide for myself? Being whether you're a realtor, whether you're a mortgage broker like myself, or whether you're just a consumer looking to purchase a home, you kind of really want to get your finger on the pulse of what's going on with the actual economy right now and mortgage rates in general, what is going to influence that shift from staying the same, going lower, or coming higher. So let's move on to it. Hopefully that kind of gives you a framework of what I'm going to address right now. What I really want to address is there a recession looming? And what I found is that there's three indicators of a recession. And I got a lot of this from doing research with regard to mortgage coach. John Mennel did a great thing on this. He's a mortgage broker as well, keeping current matters, how money works. I've looked at a number of different kind of I would say reliable sources to get this information. And so I wanted to share those with you. So there's three indicators that I found that we can actually pinpoint. Okay, this is kind of indicating there's going to be a shift here. So number one, SOM rule. Number two, inverted yield curve. And number three, the Fed. Obviously, when it comes to the Fed changing rates, that has a direct effect on it. So the idea is that in the next meeting, they're going to be making these changes. We're in August 2024, so that's going to happen shortly. Okay. All right. So, what is the SOM rule? We kind of need to start with that. What I need to let you know is that the SOM rule is probably one of those economic indicators that we do rely on. And as of August 2nd, the SOM rule was actually noted or kind of indicated. So it's a method of determining when the economy has entered a recession. So in the macroeconomic, the SOM rule or SOM rule recession indicator is a heuristic measure by the United States Federal Reserve for determining when an economy has entered a recession. It's it's very useful in real-time evaluation of the business cycle and relies on a monthly unemployment data from the Bureau of Labor Statistics. So it's named after the economist Claudia Somm. All right. This is kind of the as of August 2nd, as I said, the Fed triggered the SOM rule. It's this early recession indicator. So it's usually like, oh my God, the SOM rule's been indicating what else is going on. Are we seeing this pattern developing right now? So this goes back to the 1950s, obviously 1948 on this scale. And if you look and follow the scale, I go up to January of 2023. If you note here, what we're seeing is that these gray indicators are recessions. The red line indicates the unemployment rate, and then obviously where we currently are. So let's follow that. And what we're starting to see is as the unemployment rate increases, there seems to be a relationship between these recessions being triggered here. So that's all that they're saying is that there seems to be a relationship between these recessions and the unemployment rate. Now, how do we determine that? This is not just general unemployment rate. This is unemployment rate by not being a byproduct of a growing economy, but by being more and more people are actually claiming unemployment or offering to, enroll in unemployment assistance programs. But we are seeing a consistent pattern here leading back that there is a relationship between those two. When that unemployment goes up, a recession is either looming or we've seen it within 6 months. So Somro triggered warning, and this is kind of where we actually start to see this. If you look at 2023, 2024, we don't see this pattern happening 3 times in a row. Absolutely, we do in 2024. If you look at the M5, M6, M7 over here, what we're starting to see is unemployment contribution has risen by over 0.2%. So now we're seeing this economic indicator being triggered. And that's what actually triggered the SOM rule. And if you wanted more information, you can see I have a link down here of the actual source of the article. You're more than welcome to read into that just to get more specific information. So that's one indicator. Number two, and this is a pattern that we see quite often, and I like to share this with all of my clients and anybody dealing in the industry, because you start to see that there is this pattern of housing prices and momentum with inflation rates. Okay, so what does this mean? How do I interpret this? What I wanted to introduce you to is the Case-Shiller, and what this part of it is showing, and I just wanted to show you all the cities, is that within all these cities, within the last 12 months, we've seen an increase in values. So this doesn't affect home values, but the opportunity to buy a home increases when the rates drop. So that's why we're kind of leaning towards, hey, this may be the best time for you to go ahead and look into purchasing. Or if you're working with clients that are looking to upgrade their homes, now's a good time to try to get that plan in place. And when that opportunity arises, because remember, luck is a byproduct of opportunity, meaning preparedness. So we're getting prepared for that opportunity that's coming. So the Case-Shiller historical data, this is basically kind of showing a microcosm of that under some different guises. One is we're actually seeing home prices in the red. We're seeing building costs, which really isn't kind of what we're addressing. We're also seeing an increase in population. So I wanted to show you that those two are highly coordinated, especially after the Great Depression. As we see populations and grow, increase, home prices do increase. What I wanted to pay special note to is if you look down here to the interest rates, what we're seeing with interest rates is there's really not a lot of movement between interest rates. It doesn't have a lot of direct effect on home prices necessarily, or population for that matter. So it's kind of an unrelated effect, but you will see a relationship between these two, and that's kind of what the next slide is really going to address. So housing stays strong through recessions, and again, this is going back. This is um, the basic model that we're kind of going on, and I focused on particularly the San Francisco metro area. So based on a January 2000 value of 100. So that's 165% above that of January 2000. So we're seeing this in this number down here. Oh, I'm actually pointing to, which isn't going to help you. We're seeing that down here. And what we're seeing is there's two basic shifts that are happening. They're both proceeding up. And we're seeing a really, really, really strong relationship between the Case-Shiller home pricing index and where the economy actually is. So as we start to see that home prices are increasing, we see that they actually, home sales increase with those prices when rates go down. Why is that important? Because during recessions, we've seen, this is the history of that, we've seen 74 times where the home prices increased as rates went down. So there is a direct correlation or relationship with that. So what are the probability of the U.S. recession being predicted by Treasury spread? This is what this is basically encapsulating. And what we're seeing is as um, the the basically the Treasury bonds and the rates go up, we start to see that there is a recession that quickly follows. So you're starting to see that the rates go up, and then a recession quickly follows. Rates go up, recession, 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 1991, 1980s. Here we have that 2001. This was that really, really odd cycle in there. Again, another really odd cycle that started in 2006. And then as rates went up, it caused another recession in 2009. And again, we're seeing that relationship. Conversely, in 2019, it actually occurred afterwards. So we are seeing that there's a direct relationship between the movement of the rates as an indicator of recessions. And why is that important? As I was telling you at the beginning, one of the indicators is that we start to see that the T-bond market, which is normally a safe way to park your money or an investment that you can make, usually shows an inverted market. And that is where this actual transition starts to happen, where we start to see that, oh my gosh, we're starting to see that we have inverted T-bond market. We start to see that home prices are still increasing while rates are increasing. We start to see that there's basically um, a an indicator with unemployment, the Psalms rule, that's also giving us another indication. So what does this all mean? This all means that as these rates go up, we usually are following it by a recession. The good news about a recession, and we've seen this historically, is that if you look at this recession, after these hit, we start to see that rates go down. So that's kind of the pattern that we're really trying to predict now is where is the peak of the market? Are we there? And are we going to start to see a shift with the markets coming down? And there is a statistical relationship between the movement of the market and presidential elections. Usually we've seen 9 out of the last, I think, 11. We've seen an actual drop in rates with a change in leadership, sometimes with the same, president being elected. Okay, so this is that inverted curve. What I wanted to tell you about this that I think is it's important as an indicator, but it's a little confusing if you're not into this. But let's just look at it like if I make an investment for 10 years, I'm expecting to get a higher rate of return, more money back for that 10-year investment than I am for a 2-year investment. And what we start to see is as those people have invested in the 10 years, now we're seeing the rates for the 2-year return equivalent to that or higher. And so when you start to see this confusing kind of shift here, which you see here currently coming up, we start to see that basically it's kind of a predictor of sorts for a recession. Again, with the other 2, 3 models and a number of other indicators, we can make with relative certainty a prediction that we're in a recession, economically speaking, and that we're going to see some kind of a change in the market. My focus is obviously the mortgage market. So what we're seeing is as this is happening, we're getting an indication that we are in a recession right now. We're going to see rates shift from where they are currently to dropping a little bit. Just going to be honest with you. We're not going to see 2, 3% rates. That's not what I'm talking about. But we are going to see the statistic average, which is between 4 and 6%, which we've seen over the last, I don't know, 60 years. So we are going to see this drop. We're not going to keep rising rates. So now's a great time to actually purchase a home, or if you're looking at purchasing a home, to start preparing for the opportunity when that rate lowers to where it can make your payment affordable. Okay, with that, I just wanted to show you this. Sorry, this is a little bit blurry, but there was such a good screenshot of this and the indicator that I wanted to show you. What we start to see is during a recession, rates drop. During a recession, rates drop. And here's 18 to 13. So you can see that rates normally are pretty high. Here's that 4 to 8. This is a normal range. This was way exception to the rule. So if you look at what we start to see is basically during recessions, we see a rate shift or a rate drop would be a better way to kind of look at this. So we've seen this happen almost consistently during every recession leading back to 1942. So this is definitely, there is a relationship between mortgage rates and a recession occurring. And for obvious reasons, the government's going to respond if the economy slows down. And they're going to respond with all kinds of incentives and ways to help out, like the Fed right now is then going to cut rates to make houses more affordable. Why is that important? We've seen, and here's just another viewpoint of that same thing. What we've seen is that as this progress happens, obviously we're going to get a lower rate for mortgages. Why is that important? Because if you look at the statistics, as it drops, rates drop 1%. So let's say they drop from 7 to 6%. What that usually does is allow a more affordable market for people to move into, i.e., your house payment is more affordable. And that would equate to, I think we're looking at maybe we average, 5 million per 1%, um, 5 million people per 1% rate drop have the opportunity to have a more affordable home price. Meaning we usually can see a shift where we see maybe about 5 million people per 1% rate move into that market. So it's a good time to really start preparing for that. Make that preparation part of the process that you're going through right now. And if you have an idea what you need your payment to be at or what that rate that you're looking for, now's a great time to absolutely get ready for it. Try to figure it out. And as soon as that happens, pull that trigger. So that way now you're moving in and you're changing your kind of your livelihood and your economic status. Obviously, owning a home is probably one of the greatest things that you can do. Okay, so how can I use this information to generate more business, to do more stuff? I talk to realtors all the time. I talk to just individuals buying it. Here's some stuff I put down: educating your friends, educating clients, letting people that are in the market, talking to your realtor, talking to your broker, your financial advisor, stuff like that. Getting those buyer agreements squared away so that you know as soon as you are ready to pull that trigger, you already got your agreement in place. When those rates hit, you go for your approval, you get all your paperwork in order, and then boom, you're in the market and you're ready to go. You found that opportunity and you definitely were prepared for it. Okay. One of the things I like to talk about is if the rates are high, like let's say you're like, 7 to 6%, Austin, that's not going to help me out really. That's not what I was needing to move into a house. And I don't know if it's going to hit 5. Well, if we know that during recessions rates drop, then now might be a good time to talk about the 3-2-1 or the 2-1 buy downs. That's where you go in with whatever the current rate is. And for the first year, you get 3% below that rate. The second year, you get 2% below that rate. The third year, you get 1% below that rate. So these are buy downs that are going to have to be paid for by sellers most of the time, but they are opportunities for you to get into the market, even if it hasn't shifted to where you want. But just predicting that we're probably going to see that flow, or the way the real estate market's moved, we know it's going to average that 4 to 6% eventually. So you're going to be in that window. Also, future payments, rate agreements for action. Do I want to refinance? Do I want to pull out a home equity line of credit? We call them HELOCs, these kind of things. So understanding how the market's moving can help you to better, be informed about decisions that you're planning on making with regards to your house's value, or the loan that you currently have or want to take out. Okay. I have my information there. I know this is a lot I'm throwing on you, but I just wanted to give and share with you some of the stuff that I'm doing, that I'm realizing, and that I think is important, because right now we're probably about a month out from any of these shifts actually happening. But when the market pretty much, did a super shift about 2 weeks ago, a lot of people with 401ks were super worried because all of a sudden those 401ks weren't making the progress that they were before. And this is one of those other indicators that starts to make that shift happen. We know we're in a recession. We know a recession is looming, if not already here for most of us. So this is definitely the best time to get prepared, because that opportunity is coming down the road. All right. Please reach out to me. My email is there, MLO, that's mortgage loan originator .a Lawrence at gmail.com. I also have my phone number there. Feel free to shoot me out a text. I'd love to set up a meeting, go into any of this information in more detail, or help you out if you have some other questions, information, or stuff that you're dealing with regards to mortgages or finance in general. Reach out. I'd love to have this conversation with you. All right. Thank you very much. I really appreciate you being here. Please like the video, share it with your friends. I'm not a secret agent. I want to get this information out there. I want to get the conversations happening. The more empowered we are, the more we can make these changes benefit us. Thank you. And what I always say, because I am the mountain biking mortgage loan officer, I will see you on the trail. Thank you.